We're so excited for the return of our Master Series. For those of you that maybe have not tuned into one before, it's a series that we put together quarterly, which really dives into top topics and challenges in the industry and allows us to really pull together subject matter experts to have a really engaging dialogue and make sure we're all equipped to face any challenges in the future. So let me first get us started. So we do have AIA credits for this. So if you need a certificate, please email us after. We're happy to provide the certificate to you. So 1 learning credit for today's session. I just want to start, we do start every HITT meeting with a safety moment. So I thought I would just draw awareness to April is actually Distracted Driving Month. And so I just wanted to, I know we're all guilty of it, but I would just ask everyone to stop and try to be really mindful when you're driving. Put down your phones. Don't make sure you have 100% attention on the road and that you're not distracted while you're driving. A couple of housekeeping items. There is a chat box that is live during the session, so you can put questions in there. Our team on the back end will moderate those and provide those to the panelists to answer. For those of you that submitted questions in advance, thank you so much. We received over 100 questions from you to answer today. So we're going to do our best to power through those and provide a great session for you. All right, so let me dive in and introduce today's topic and our panelists. So today we're going to talk about the economic outlook of the construction industry, real estate, and really current market trends. We're going to talk about a variety of different topics from overall economics and real estate, the pending election, and then certainly any other challenges we might have ahead. So let me introduce our panelists. First, we have Anirban Basu, who founded the SAGE Policy Group in 2004. Happy 20-year anniversary. Dr. Basu earned his BS in Foreign Service from Georgetown University, his master's in public policy from Harvard University's John F. Kennedy School of Government, his master's in economics from the University of Maryland College Park, and he acquired his JD from the University of Maryland School of Law and completed doctoral work at the University of Maryland, Baltimore County with a concentration in health economics. And then in 2014, Governor Larry Hogan appointed Dr. Basu as chairman of the Maryland Economic Development Commission, position that he held through 2021. Certainly a great panelist for us to have today to really guide us through what's happening in the market. And then to my immediate left, PJ Ross, our CFO at HITT Contracting. He joined us in 2018 and brings with him over 2 decades of experience covering corporate strategy, financial planning and analysis, reporting, M&A, due diligence, and integration, and ERP system migration experience. As the CFO, PJ handles all financial matters for our company, including executive oversight of our accounting team, our corporate and our national project accounting team, as well as IT infrastructure, cybersecurity, and enterprise applications. Certainly also very qualified for the dialogue today. So without further ado, I'm going to hand it over to Anirban for you to share some of your slides.
Right, I hope you can see that. I think you can, because I'm told that if I want to stop sharing, I could. So that means I must be sharing. Thank you very much for the invitation. Thanks to HITT Contracting for the opportunity to converse about the economy with some of the organization's most trusted, experienced, valuable leaders. My presentation today is entitled The Good, the Bad, and the Ugly. This is a Clint Eastwood economic forecast presentation. You'll see that Clint Eastwood theming throughout the presentation, whether you like it or not. I hope you don't hate it, but it's firmly baked within the cake. Today, I'm going to share with you some good, some bad, and some ugly. But let me begin with the good. And the good, of course, can take many iterations, many incarnations. But perhaps most broadly speaking, the incarnation that it takes is the fact that the U.S. economy has outperformed everyone's wildest expectations. There had been a conventional wisdom coming into last year, 2023, that recession was inevitable in the United States of America. In fact, the economists at Bloomberg, the source of that fabulous business intelligence, maintain a forecasting index, and that forecasting index suggested, as of October of 2022, that the probability of recession in America was 100%. Now, you may be aware that is the highest possible probability. It's the highest possible percentage, unless, of course, you're talking about the Baltimore Ravens defense, which, as you know, gives 110%. But otherwise, 100% is the most. We had a very bad year for the U.S. equity markets in 2022. Of course, interest rates took off in 2022, and all of this was meant to be precursor to an economic downturn. But we did not have a downturn in 2023, and that momentum has continued into 2024. The broad indication of U.S. economic progress is growth in gross domestic product. And Where Eagles Dare, that's a 1969 Clint Eastwood movie, also starring Sir Richard Burton. But in any case, this is a gross domestic product. Much of the data I will share with you today are time series data. So the more contemporary data are to the right of the slide. In fact, the last 4 bars here are the 4 quarters of 2023. So during that first quarter of 2023, the U.S. economy grows 2.2% on an annualized basis. Second quarter, 2.1%. And there was this notion, oh, the economy is slowing now. Maybe we will have that. We will have that recession in the back half of 2023. Nope. The economy picks up momentum. It's not because interest rates fall or anything like that. Just the economy picks up momentum. We'll talk about why that is in a moment. But that 4.9% performance, that breakout quarter in the third quarter, the capstone for the year, that 3.4% performance during the fourth quarter. Now we're in the second quarter of 2024, but the Bureau of Economic Analysis is yet to release first quarter GDP data. So statistically, we're still in the first quarter. And the Atlanta Federal Reserve provides an update or a forecast, an estimate for current quarter GDP. And because statistically we're in the first quarter, their latest estimate is for the current quarter, and the U.S. economy during the first quarter appears to have grown in the range of 2.4% on an annualized basis. None of these are indicia of recession. And indeed, certain parts of the economy continue to outperform, including the American consumer. The consumer is 70% of aggregate demand. HITT supports the consumer in ways directly and indirectly, including in multifamily construction, for instance. We'll talk more about that. This is monthly retail sales. The last 2 bars here are January and February of 2024. And admittedly, January and February were a bit weak. But many economists attribute that to weather and other seasonal factors. And if you look at retail sales where they've been compared to the pre-pandemic level, when the economy was deemed to be very, very sound, remarkable. The American consumer has been on a spending spree. It is often said you should never stand between an American and a cash register. And you know, we set last holiday or Christmas shopping season a record Black Friday, a record Cyber Monday. But much of the growth action consumer outlays has been on services, things like travel. So we recently set a record for the number of people passing through TSA checkpoints on a single day. They're buying Beyonce concert tickets, Taylor Swift concert tickets. In August of 2023, the average Taylor Swift concert ticket purchased on resale, and that's how people buy them on resale, sold for $1,619 per ticket. And she sold at major football stadiums and cities multiple times. She just toured Australia, February 23rd through February 26th in Sydney. The Australian government has indicated she improved our economy. She alters gross regional product. She alters hotel occupancy wherever she goes. She's not merely a musical phenomenon. She's an economic one. And by the way, I think, and I think you would agree, that this thing between Travis Kelce and her is the greatest thing ever. It's exactly what this nation needed during these troubled times. It's fabulous, not at all annoying. And what you have here is this hunky, ruggedly handsome athlete from the Kansas City Chiefs, 3-time Super Bowl winner, tight end Travis Kelce, and this savvy singer-songwriter, independent-minded businesswoman, the quite lovely Taylor Swift, and they're in a relationship. There are pictures of them kissing on the internet. Some of that's artificially generated, of course, but nonetheless, it has many Americans aglow and a buzz. And unlike many stories, this one's going to end well because they are such an attractive couple. They're going to produce one very beautiful #1 hit song, because when that breakup occurs, and it will occur, the music is going to flow, and I, for one, cannot wait. But in any case, the consumer is active. Now, later on in the presentation, I will address the question of whether or not the consumer, 70% of aggregate demand, can continue to spend this way. And part of that question revolves around the demography of America. This is the breakdown of American wealth by household percentile or wealth percentile. So you see that teal segment at the top of the slide? That's the wealth controlled by the top 0.1% of Americans. So that's David Rubenstein, who just bought the Baltimore Orioles, or Matt Ishbia, who owns the Phoenix Suns, or Elon Musk, or Jeff Bezos, so on and so forth. The top 0.1% of Americans control about 14%, 13.9% of American wealth. It's a fabulously wealthy nation, so that's a ton of wealth to be concentrated in the hands of relative few. Not critiquing that, by the way, not making a social statement, just pointing out what the Federal Reserve data indicate. Now, if you look at the balance of the top 1%, so that's your 99th percentile to your 99.9th percentile, another 16.6% of wealth. So the top 1% controls a bit more than 30% of American wealth. The balance of the top 10%, so the 90th percentile to the 99th percentile controls 36.1%, which means the top 10% of Americans control almost precisely 2/3 of American wealth. The 50th to 90th percentile controls about 31% of the wealth, which means that the bottom 50% controls or possesses about 2.6% of the wealth. So again, not making a social statement, but many of those people on fixed incomes or living paycheck to paycheck, they can not rely upon accumulated wealth to pay their bills. Now, here's the good news. Lots of paychecks right now. This is from the JOLTS, the Job Openings and Labor Turnover Survey. Latest data reading is for February of 2024, and in February, America home to 8.8 million available unfilled jobs. Construction associated with about 441,000 available unfilled jobs, the second highest monthly total on record. The highest had been in late 2023, parenthetically. And I would think that for HITT Contracting, and for many others, of course, general contractors, subcontractors, whomever, that the number one problem continues to be finding enough talent to do the work. And that's not simply the skilled workers, meaning the technically proficient or skilled tradespeople. We don't have enough carpenters, electricians, so on and so on. That's true. But now we see these shortages of the construction manager position as well, superintendents, so on and so forth, foremen. So it's across the construction industry, the occupational categories. About 1.4 job openings in this country for every unemployed American. Now, number of job openings has been falling. You can see that from the chart, remains well in advance of what it had been pre-pandemic, when the economy was deemed to be very, very strong. Back then, we had a 3.5% rate of unemployment. It was a 50-year low at that time. So, remarkable. And when you enter each and every month with lots of available unfilled jobs, what are you going to get that month? New job creation, as people try to fill those available unfilled jobs. So this is multi-job growth in America. Last time America lost jobs was in December of 2020, a COVID-intensive month. We've added jobs ever since, each and every month. We just got the March jobs report in last Friday, and in March, America adds a titanic 303,000 net new jobs, well above the consensus estimate. Unemployment falls to 3.8%. Wage growth on a year-over-year basis, well over 4%. And of course, labor flexed its musculature last year. We had strikes among writers, actors, UAW members, but some negotiations did not end in strikes. Let me give you an example. The negotiations between the Teamsters Union and UPS, United Parcel Service, those negotiations produced a 5-year contract. And during the 5th year of that contract, the average full-time UPS truck driver will be earning $170,000 per year. That's $170K. Now that is wages plus benefits, but it's $170K. Forcing people like myself to ask the question, how to look in brown? And based on the app, spectacular. But the point is that's inflationary. But if the issue is, can consumers continue to spend that kind of wage growth? The answer is yes. Consumers continue to spend. The labor market supports that. So we're in the midst of this virtuous cycle. Consumers are spending, impacted employers are hiring, which fuels further spending. And of course, job growth has been faster in certain parts of the country than others. And I'm using this as a proxy for regional economic strength. And of course, HITT Contracting has at least a national presence. So employment growth, 25 largest metropolitan areas, comparing February of 2020, why that month as the baseline? That's the last month before we shut down the economy. So the public health emergency is declared March 13th of 2020. So February 2020 is the baseline pre-pandemic level of employment I'm using here, versus February of 2024, the last month for which you have data. It just happens to be another February. So exactly 4 years of comparison or comparison period. So if you look at the left-hand column, you see the fastest growing markets in the country. Number one, Dallas, Texas. There's a neat little correlation between population growth and job growth in recent years. No region of the country has added more people in absolute terms than the Dallas metropolitan area. The place is booming. I delivered a presentation about 4 weeks ago in Grapevine, Texas, and contractors at that time there said, we don't really see a sign of slowing here. Football team's terrible. What have they done during free agency? Absolutely nothing. But very strong economy. And you'll notice that the South is overrepresented in that left-hand column. Tampa, Phoenix, Orlando, San Antonio, Charlotte, Houston, Texas, Miami, Riverside, California, Atlanta, in those fastest growing markets. Now, Philadelphia makes it into that left-hand column, part of the Northeast contingent. Now, during the pandemic, we saw many people move from more densely populated, more expensive communities to less densely populated, less expensive communities. Now, Philadelphia, don't get me wrong, is expensive and dense, but not compared to New York. So we saw that movement along I-95 to the south, including to the Philadelphia suburbs. We also see that continue with the movement of Saquon Barkley from New York to Philadelphia. But for the most part, the Northeast is in the right-hand column: New York, Washington, Boston, my town of Baltimore. Less population growth, less job growth, and also the Midwest, St. Louis, Chicago, Detroit, Minneapolis. Again, less population growth, less job growth. Now, I find this slide to be quite compelling, and we'll talk about this in the construction context regionally later on in the presentation. This next slide is far more important macroeconomically. It's the same 25 major metropolitan areas as it turns out, but these are unemployment rates as of February of 2024, the last month for which we have sub-national data. The point here is unemployment rates are low everywhere. So that's great for job seekers. We just got this morning at 8:30 a.m. Eastern Standard Time information about initial claims for unemployment insurance. They're still very low, came in at 211,000, historically low. So employers still clinging to their workers, compensation levels continue to rise quite rapidly. And that's great news from the perspective of consumer spending and the right now economy. The economy as it is right now has momentum, driven in large measure again by consumers, federal spending, and of course, construction, all those mega projects that we'll talk about as we go through the presentation. But if we're thinking about inflation, interest rates, this is a problem. You've probably heard that inflation's come in a bit hot early this year. And that, along with the impact on interest rates, raises the question, is this current economic expansion sustainable into the medium or longer run? And again, at the heart of that question is the American consumer. Cannot have an economic downturn unless the consumer participates. And right now, the consumer is not participating in any downturn. You will hear, of course, occasional retailers, Dollar General, Family Dollar, some restaurant chains say, we see some weakness out there, but by and large, consumer outlays continue to be quite significant. Anyone who's flown recently knows that the planes are, for the most part, pretty full. So let's talk about that consumer a little bit more. This is personal savings, personal household savings. So green line at the bottom, measured in hundreds of billions of dollars of savings. And you can see that smooth trajectory of savings during the late 2010s, and then the pandemic strikes. Now, these data come from the San Francisco Federal Reserve. So what happened here? So during the pandemic, many Americans received stimulus payments. They saw wage increases. Many people didn't lose their jobs. In fact, many construction workers did not lose their jobs. Construction was deemed, for the most part, to be an essential industry. But so their income was going up, but the outflow was going down. They were not taking vacations. They were not seeing Beyonce or Taylor Swift in concert or Ice Spice. Not going to restaurants, movie theaters, plays, so on and so forth. And so they amassed a lot of excess savings, being savings above and beyond what they would have saved but for the pandemic. And according to the San Francisco Federal Reserve Bank economists, in the pinnacle or at the pinnacle, they had amassed about $2.1 trillion in excess savings. Those same economists find that almost all of those savings have been spent by the end of last year. So now you have a consumer who spent down their pandemic era savings. I'm not talking about the top 0.1%. Jeff Bezos is going to be just fine, don't worry. Elon Musk probably make it too. But for many Americans who don't have much accumulated wealth, they've spent down their pandemic era savings, and now what do they face? High and rising prices. Consumer Price Index, prominent measure of inflation. This is 12-month percentage change in prices. Two lines here, the dashed green line represents the overall rate of inflation. Now, we got data on that yesterday for March, and you might have heard inflation came in red hot. That's why the Dow Jones fell nearly 500 points yesterday. Because higher inflation implies higher interest rates for a lengthier period. And that's not good for project financing. For instance, we'll talk more about that. So you can see that inflation had been higher. Back in June of 2022, inflation was at 9.1% year over year, now down to 3.5%. And if you just based on those numbers, you say, oh, just extrapolate those numbers, 2%, which is the Federal Reserve's target, must be right around the corner. But if you look at that green line carefully, you can see that inflation becomes stubbornly stuck above 3%. And one of the things that we have is not just the wage pressures. So to have 2% inflation, you probably need wage growth between 3 and 3.5%. It's still running between 4 and 5%. But then, of course, we've got these newly emerging supply chain issues, Red Sea, Panama Canal, Baltimore, so on and so forth. And so that's also putting upward pressure on prices. We'll talk about the Producer Price Index later on in the presentation. Moreover, if you look at that dark blue line, that's your so-called core rate of inflation, all items less food and energy. So natural gas prices have fallen a lot recently. And so if you take out certain energy and food prices, actually inflation measure is higher at 3.8%, in either instance above 2%. Now, the Federal Reserve has a measure of inflation that it prefers to these. It's called the core PCE deflator, the personal consumption expenditures deflator. That says inflation is running at around 2.8% year over year, but still not to that 2% target. And, again, speaking about the consumer, what's the effect here? Now, this is, again, consumer price index data, just taking the percentage change in prices between March of 2023 and March of 2024. If you look for the bottom of the slide, you can see the headline numbers, 3.5% overall inflation, 3.8% on the core. And please note that these increases in prices are over already high prices. And if you look at these green color bars, you still see some fairly chunky rates of inflation. So transportation services up 11%. Well, of course, if the UPS truck driver is going to make more money, and not begrudging them that compensation, by the way, the UPS truck driver is a very special person. They have to be able to drive a large vehicle, have to be able to park it, they have to be able to lift heavy objects as much as 70 pounds or more, and pass a drug test. Most Americans cannot do all of those things, though I will say that a lot of construction workers can. A lot of construction workers can drive a large vehicle, park it, lift heavy objects, pass a drug test. So there's competition for this kind of worker right now. That's inflationary. Shelter, that's about a third of the consumer price index, up nearly 6%. That includes things like apartment rents. We'll talk about the apartment market later on in the presentation. And the effects, again, of this are cumulative because prices have been rising rapidly for quite some time, not just the last year. So if you were to compare prices based on the consumer price index in May of 2020, why that month is a baseline, that's the first month of the economic recovery from the pandemic. So America loses 22 million jobs in March and April of 2020. We start to add back jobs in May of 2020. Indeed, the recession is declared over in April of 2020, to have ended in April of 2020. So if you look at prices as they were in May of 2020 and compare those to March of 2024, again, the last month or two of these data, food prices up 22%. Overall inflation, 22%, if you look down below. Strip out food and energy prices, 19%. Used car and truck prices, though falling over the past year, up 31%. New car price up 21%. Tobacco and smoking product prices up 31%. So one of the worst things you can do is smoking a new car because that's bad for your health, destroys that new car smell, but also renders well susceptible to a lot of this inflation. And that's what really has Americans upset, by the way, more than any other factor. It's inflation. You talk to, one of the things I do, I take a bunch of Ubers. Because often I'm delivering presentations in person. Yesterday, I was in Denver, Colorado. So, Uber from their airport, and their airport is barely in Colorado, as it turns out. Setting that aside, Uber to Denver, downtown Denver, and then back to here. So I did a lot of Ubers and Lyfts. And those of you who do that know that as a passenger, you rate the driver. You may be less aware that the driver rates you as a passenger. And I have become privy to my passenger ratings, and they're extremely low. And you say, oh, that's a surprise. We've been watching on this webinar. I think it's beyond personality, because I take every Uber or Lyft trip as an opportunity to interview an American. And I ask them questions like, hey, how much are you really making doing this? Once you take into account depreciation and insurance and those kinds of things. Does your family approve? What's your highest level of educational attainment? Do you view this as a job or career? Do you have a girlfriend? Why do you choose this vehicle in particular? And apparently these questions are off-putting. But what I find from Americans as I speak to them is that the number one thing that has them upset, high and rising prices. Now, this consumer who spent down their pandemic era savings and faces these high and rising prices wants to maintain the lifestyle they've had for the last few years. So what's the only way to do that? If you don't have savings and you're facing high prices, you go to the credit card. It's the US credit card debt. And it is spiking according to the New York Federal Reserve Bank economists. And previous credit card debt has spiked with social and economic downturns, 07, 08, 09, in the early stages of 2020. And now, and it is the case that more and more consumers are finding it difficult to pay their obligations. So this is the percentage of balances 30 plus days delinquent by loan type, new delinquent balances. See the green line there, credit card. And it's rising. Now, many economists would point out, hey, this Basu, he's making too big a deal of this. Because that delinquency is rising off a very low level. There have been times in history, and this goes back to 2003, this slide, during which credit card delinquency was higher than this. So it's coming off a low level. Yeah, that's the optimistic view of things. But I'm no optimist. I'm among the most pessimistic people you will ever encounter. Didn't really have a girlfriend in high school, didn't have one in college. I'm from Baltimore. So I expect bad things to happen all the time. And March 26th, of course, unfortunately, checked that box. And so I view the trend as ominous, and it's not in isolation. In yellow is auto loan delinquency. That's rising. And of course, during the pandemic, many Americans spent a fortune buying used cars, still trying to pay down that debt. At the bottom, mortgage. Now, delinquency is very low, vice versa, very, very low, but it's rising. And again, I'm not suggesting imminent recession, not at all. What I am saying to you is that the consumer cannot continue to spend the way they have been, which implies that the US economy overall is set to slow a bit as we go forward, though not necessarily entering recession anytime soon. We'll talk about that. We'll speculate on that. And this has really surprised me, this consumer behavior. Why? Because I was taught in school that the most important price in the economy is the interest rate, the cost to access funds. So this is the commercial bank interest rates on credit card plans, and they skyrocketed over the past 2 years. So what was I thinking as an economist who puts value on the importance of interest rates? I thought the consumer was going to take on debt less rapidly. Naive. Never stand before American at cash register. They spent right through it, which has been great for retail sales, job growth, economic growth overall, but means that we have some vulnerability now in the economy. And one of the games that Americans play is this. Yeah, I've maxed out this credit card, and I'm paying these penalties and interest. No problem. I'll just get another credit card, and I'll take those balances, move them over to this credit card with that low introductory rate. I'm good. I can do that forever. But this isn't that percentage of domestic banks tightening standards for credit card loans. So it's the proportion of banks tightening standards, meaning more likely to say no to a credit card application, minus a proportion loosening their standards. The number is still well above 0%, which means more banks are saying no. And so more banks are saying you have to raise your credit score, you need to deal with this credit card debt. And so some consumers are running out of that financial flexibility. And a lot of this had been engineered. By whom? The Federal Reserve. The Federal Reserve Bank had wanted to tighten credit conditions. Why? Because they want to restore inflation to that 2% target. So this bout of excess inflation, meaning inflation above their 2% target, springs forth during the spring of 2021. Now, this is their principal mechanism by which to deal with that, to shape economic outcomes and the byproduct of inflation, the Fed funds rate or federal funds rate, the overnight bank lending rate, the rate at which banks can borrow from one another overnight to shore up their reserves. And why would a bank do that? Because a bank needs a certain amount of reserves inside the bank to make loans outside of it, and occasionally banks run up against that constraint. So when this rate is set at a low level, banks are more likely to borrow from one another, and thereby shore up their reserves and therefore lend more aggressively to the economy. When this interest rate is set at a high level, they're less likely to borrow from one another, and therefore less likely to shore up their reserves and less likely to lend aggressively to the economy. So again, inflation burst forth in 2021, and you can see here from this slide, the Federal Reserve responds by doing nothing about it. They view that inflation to be transitory. A synonym for transitory is fleeting. They think it's almost purely supply chain driven, that as supply chains normalize, that as employees are rehired, supply will rise up to meet demand. The demand was high coming out of the pandemic. And that inflation just naturally abate, therefore, to that 2% level we'd enjoyed for many years prior to the pandemic. Instead, they preside with the creation of that wage price spiral. Prices take off, wages follow, prices take off some more. And we continue to feel some of the effect of that. Now, starting in March of 2022, March 16th to be precise, the Federal Reserve begins to push back on inflation more aggressively, raising interest rates for the first time in a few years. But even that, at that point, they only raised rates a bit, 0.25% that day. So they only dipped their toes in inflation-fighting waters. But next meeting, 0.5%. Next 4 meetings, 0.75% each meeting, then back to 0.5%, then 0.25%, then 0.25%. May 3rd of last year, 0.25%, pause in June. July 26th, 0.25%, pause thereafter. And now there's lots of talk that the Federal Reserve will not cut rates at any point this year. I would still expect 1 or 2 cuts, but we'll see, because inflation is coming in hot, and so the Federal Reserve does not have much maneuverability right now. To try to get inflation down to 2%, it's stubborn, it's not getting down to 2%. So in my mind, interest rates higher for longer. That might help explain why the Dow Jones is down by another triple-digit figure today. And here's the issue. I mean, I'll express some skepticism or pessimism about the economy in the next few months. And a lot of economists won't. So only about 50% of economists think that recession is coming in the next year or so. And I'm not saying it is coming or not coming, not yet. But I see some weakness. And the perception or my forecast of weakness is based largely on theory. It's not on the economic data, because the economic data say labor market is strong, consumers still spending. So momentum says the economy is going to continue to grow. But I think beyond the near term, you're going to see some further weakness, and we'll talk more about that. So I won't go through all of this in the interest of time, but this first bullet matters to me at least. It's a quote from Raphael Bostic, the highly regarded president and CEO of the Atlanta Federal Reserve Bank, who says, quote, a large body of research tells us it can take 18 months to 2 years or more for tighter monetary policy to materially affect inflation. You say, Anirban. You might say he's highly regarded. That is sheer nonsense. Because you just said yourself that inflation has gone from 9% to around 3.5%, and that over an overlapping period, the Federal Reserve was raising interest rates starting in March of 2022. So clearly, tighter monetary policy has a material effect on inflation. Here's my view, and to the extent that you disagree with my hypothesis, your view of the economy will differ from mine, and you'll disagree with my forecast, which is just fine. My view is that the reason the economy has performed the way it has over the past 2+ years is because supply chains have improved. I'm not saying to you they're perfect. Anytime I speak to a group of mechanical contractors, they're so quick to remind me about their lengthy lead times for switchgear and generators, et cetera. I understand. Nonetheless, as a general proposition, supply chains are more reliable than they were late 2021. And here's what happens economically as supply chains improve in the context of unmet demand. Let's take new cars as an example. For a while, Americans could not find new cars on dealership lots. So what did they do? They bought used cars. What happened to the prices of used cars? They skyrocketed. But then new cars began to show up on dealership lots. All of a sudden, Americans had optionality. All of a sudden, used car prices were not rising so rapidly. In fact, they've fallen over the past year. But moreover, there was frenetic, frenzied demand for those new cars. So as they hit the dealership lots, they flew off the dealership lots. So what do you get as supply chains improve in the context of unmet demand? You get tons of transactional value. That's economic growth. And you get less inflation as Americans benefit from optionality. I can choose new cars now over used cars, for instance. I have a choice. And that's exactly what explains, I think, how the economy performed over the past 2+ years. Rapid economic growth, less inflation. My view is that these higher interest rates have yet to fully permeate the US economy. And again, it can take 2 years or more for tighter monetary policy to materially affect inflation and the broader economy. And I think some of that effect is still in front of us. Now, I'm not saying
Anirban, question for you. With this lag of impact that you see, and we talk about it in a tightening cycle, when they reduce the rates to the floor, and now that we're 12 to 18 months past those sub 3% mortgage rates, are we seeing more long-term effects from that are negative, or are those being kind of convoluted by other more recent economic impacts?
So I think we are starting to see more impact from that. So I'm seeing more and more contractors tell me that in addition to having issues finding sufficient human capital to do the work, that increasingly project financing is a problem for them, or project financing is a problem for the clients for which they would otherwise work. So I am starting to see these lag effects start to infiltrate the broader economy. And again, I'm not suggesting to anyone in the audience that they've had no effect whatsoever. In fact, right here, you can see some effect in the form of these higher mortgage rates, 30-year fixed mortgage rate in blue, 50-year fixed mortgage rate in green. Now you might say, these are from Freddie Mac. Anirban, 6.82% on 30-year fixed mortgage rate, that's just not a big deal. My first mortgage rate was 18%. My first mortgage rate was 15%. I understand. But to millennials and Generation Z, the youngest members of our workforce, these rates are preposterously high. They've not seen this before in their waking adulthood. And that's what subtracted themselves from the housing market. It's been that would-be first-time buyer, frustrated by high prices, a lack of inventory, and now by their standards, extremely high borrowing costs. Now, as I move toward the tail end of this presentation, I want to leave at least 10 minutes for Q&A. I'm going to show you a number of leading economic indicators because I want to pivot from a discussion of what's been happening to a discussion what's likely to happen going forward. Here's a leading indicator. It's mortgage applications. This is the U.S. mortgage loan applications composite index. Why is this a leading indicator? Because the pathway to the settlement table, the pathway to homeownership often begins with a mortgage application. That's the signal that somebody wants to transact. However, mortgage applications are down 78% from that 2021 peak. Now, what does that mean? We have fewer near-term buyers looking in the marketplace. That's what that means. And so demand to transact, to buy homes is really dried up on anybody. That's exactly what I'm suggesting, at least among many populations, especially younger populations. The housing market is in terrible shape on anybody, therefore. Nope. There's another aspect of economic life that has been surprising. Here's the S&P Case-Shiller Home Price Index. It's a measure of home sales prices. You see that increase in home sales prices during the pandemic and early stages of recovery. That's a 45% increase in US home sales prices. And of course, during the pandemic, our behavior changed. We wanted more house. We're spending more time at home. We wanted more square footage. We wanted room for home offices and home gyms. We wanted one room just for the Peloton. Anytime you see a Peloton commercial, it's the only piece of furniture in that room. That's how Americans want to live. Just lock that thing away. Never see it again. And they want to get advantage of the lowest mortgage rates in the history of this country. But then the pandemic ended and mortgage rates took off. So what was I thinking naively? Oh, home prices are going to start to really fall. And for a few months they were. But now they've peaked again. Why is this? Well, I had underappreciated the fact that, yes, we have fewer prospective or would-be buyers out there. We have also fewer prospective sellers. Because if you're sitting in Kankakee, Illinois, or Kenosha, Wisconsin, or Bakersfield, California, with a 2.75% 30-year fixed, where are you going? You're not going anywhere. You're going to have to be carted out of that house. You're going to leave that house in an ambulance. So not many buyers, not many sellers, equilibrium, high price. Now, these dynamics will also tend to impact construction. So for instance, this is new single-family homes sold, single-family. I understand HITT is involved in multifamily. We'll get to that. You look at this, you say, oh, it doesn't look great, but it also doesn't look terrible. It's sort of, if you strip out the housing bubble of the mid and early 2000s, this is about a historic average. I'm not adjusting for per capita. So back in 1964, when this chart begins, there are about 191 million people in America, now more than 330 million. So yeah, that's true. Population has grown 75% since 1964. Nonetheless, it's not a disaster, given how low mortgage applications are and given that mortgage rates are so high. Why is it not a complete disaster in terms of new homes sold? Because there are so few existing homes for sale that single-family builders are spying opportunities to satisfy unmet demand. And again, that shows up in the construction data. This is US residential building permits. It's a leading indicator because if you're a builder, you've got to pull a permit before you build. The orange line there at the top, that's your single-family building permits. And you see momentum there. How could that be, Anirban, after all you've said? Again, because there's so few existing homes for sale, and because the millennials, our large generation, are forming households, and to the extent that they can transact, often they find that house in the newly built market, the single-family new construction market. Actually, the odd thing here is, also another odd thing, is that the loss of momentum is that multifamily category in green. That includes your future apartment construction. And don't get me wrong, as HITT and everybody else knows, we've seen a ton of apartments under construction and delivered to the marketplace in recent years. Absolutely. What this relates to is the next wave of apartment construction, which is set to be smaller in amplitude than the past few waves. You say, why, Anirban? The millennials are now the most populous generation. If they can't find homes that they can afford, that they want, that they can buy, and they can't live with their parents forever, can they? Actually, they can. But if they don't want to, then they have to lease an apartment. So I would think apartment leasing would be quite strong in such context. Oh, it is. Then why are multifamily building permits falling? Because increasingly, project owners, meaning developers, are having a tougher time lining up project financing. And that dynamic, of course, extends well beyond multifamily into other segments of real estate. There's no leading indicator. This is the Architecture Billings Index. You see the 50-yard line running west-east across that slide. Any reading less than 50 signifies that architects are less busy this month than they were last month. And lo and behold, if you look toward the end of the series, last 7 months, the reading has been below 50. Now, February was a bit better, 49.5, but it still means that architects on average were less busy in February than they were in January. And they're less busy in January than they were in December, so on and so forth. Again, I think at the heart of this, project financing. More difficult to obtain. And sometimes developers can line up financing, of course, but the interest rate they're being offered is so high, their pro forma no longer pencils out. So what do I need the architect, to build me for? I can't move forward with this project in any case. And that takes me to a more full-fledged discussion of non-residential construction. And I use this movie as the segue to that. So The Bridges of Madison County. This is Clint Eastwood as Lover. So previous movies, it was him shooting up people in the Wild Wild West in San Francisco. Here he is co-starring with Meryl Streep. Meryl Streep is nominated for Best Actress coming out of this film. And this is a film that Clint Eastwood acts in, of course, but also directs and produces. The gentleman has more than 40 directorial credits in his career. He's one of America's most accomplished directors, not simply actors. And here's another thing about this presentation. It's not just Clint Eastwood oriented or themed. It's going to get better now. There's 2 pieces of good news I have to offer you. Number one, this presentation is almost over. Number two, at this moment, I can tell you almost anything you want to hear. So if you want me to tell you the economy is great and going to get better and go on CNN and say those things, I can do that for you. If you want me to tell you the economy is terrible, it's going to get worse and go on Fox News, I can do that for you. I can do whatever you'd like because I have enough data to support any side of the story. Indeed, I will support two relatively different stories with one data series on this next slide. This is total non-residential construction spending. That's what it is. Total non-residential construction spending. Now you see that green line there? That's total non-residential construction spending. Say, Anirban, my goodness, yeah, I can see that January and February have been a bit weak, but overall the recovery has been fabulous in construction spending. No wonder we're so busy. No wonder we've had such healthy backlog. Yeah, that's pretty impressive, except that that figure does not adjust for inflation. If you adjust for inflation, you get that dark blue colored line below it, and now it looks like a much more tepid economic recovery. Now, I can break this down for you as defined by the U.S. Census Bureau. There are 16 categories of non-residential construction in our country. All are listed here. And these horizontal bars represent the percentage change in construction spending for the 4-year period, February of 2020, pre-pandemic, versus February of 2024, last month from which you have these data. So if you look at the headline number, total non-residential construction at the top, that blue bar, so spending is up, not adjusted for inflation, 33.5%. If you adjust for inflation, around 13%. 13% in 4 years, that's not terrible, but it's also not a market that's racing higher. Now, the green color bars represent what's been happening categorically. Number one category here in terms of strength, manufacturing. That's supply chain coming back to America. That's $250 billion of computer chip manufacturing plants are developed in this country, $40 billion in battery manufacturing plants in this country, inputs to alternative energy, it's federal subsidies coming out of the Inflation Reduction Act, and the Infrastructure Investment and Jobs Act, which was signed by President Biden, November 15th of 2021, for instance. In August, he signs the Inflation Reduction Act and the Chips and Science Act. So it's Intel's investment in Columbus, it's Samsung's investment in Texas, it's Micron's investment in Syracuse, New York, it's Tesla in Nevada, it's battery factories in Tennessee, Georgia, Kentucky, Michigan, supply chains coming back home. And that's going to continue for decades. Why? Because for many decades, supply chain have been leaving this country, often for China, Mexico, some other emerging countries. But now supply chain is coming back home. In fact, we saw earlier this week, TSMC announced it's going to build another plant in Arizona. Now you can see that public categories, like sewage and waste disposal, which is 95% publicly financed, water supply, highway and street, follow on in terms of strength. Then commercial, that includes your warehouses and your fulfillment centers. So that's the e-commerce boom driving that. Healthcare, America's getting older, utilization rates are up. Hospitals are buying outpatient medical centers. That's one of the reasons that charges outpatient medical centers are going up, because hospitals are charging off in these outpatient centers something similar to what they charge on the inpatient, traditionally more expensive setting. But we're getting older, utilization's up. Healthcare will continue to be a strong segment. Of course, it's one that HITT is involved in. At the bottom, you see some of the weaker segments. Now, office is interesting. Now, again, these numbers are not just for inflation. If you adjust for inflation, office construction is down over the past 4 years. But office includes the construction of data centers, otherwise known as mission critical. Now, that's frenzied, booming, frenetic, and it's going to be for years. We're actually doing some analysis right now on future data center construction. It's going to be a hot segment for years to come, red hot. But the traditional office space, that's the category in which we see weakness, and I'll come back to that in just a moment. Now, let me talk about materials prices. This has been something that's bedeviled contractors in recent years. This is the Inputs to Construction Producer Price Index. Just got the data this morning for March at 8:30 a.m. Eastern Standard Time for the Producer Price Index. Did we update the slide for you? We did. We care about HITT. 12% change in prices. What it says here is that between March of 2023 and March of 2024, materials prices are up 1.7% year over year. You say 1.7%, Anirban, even you, as pessimistic as you are, cannot make a big deal out of that. Here's the issue. All that 1.7% has happened in the last 2 months. And if you break this down, this is 12% change in materials prices as of March of 2024. If you look at the top here, that 1.7%, that's your headline number. For prepared asphalt and tar roofing / siding products up 7%. Concrete product prices up 6.2% in the context of a global shortage of cement. We see crude petroleum prices starting to march higher, so on and so forth. So you see more of that kind of inflation. Yeah, some prices have fallen over the past year, like natural gas, but softwood lumber price actually rose last month. So too did non-ferrous wire and cable as the price of copper goes up internationally. So And again, you've got these supply chain issues emerging. So, one has to watch for that. And with that, let me take you to the ugly. Just 2 more sections left in the presentation. Give me 4 more minutes here. The office market is ugly. And the reason I bring this up is this creates some vulnerability for the US banking sector, in addition to creating vulnerability, of course, for owners of office buildings and those who historically have provided a lot of construction services to the US office market. So last year, the US economy grows 2.5%. We had hundreds of thousands of jobs in office space using categories, and yet the office vacancy rate went up according to CoStar. And that 30.7% that you see at the end of that series is a lie. We have way more than that amount of office space vacant, but it is not considered to be vacant because it is still leased. So as these lease renewals come up, I think you're going to see upward pressure on office vacancy. Some of you may have seen the newspaper article in the Wall Street Journal about St. Louis, downtown St. Louis, and the death spiral that it is in, allegedly, according to that Wall Street Journal writer. You may disagree with that, but lots of vacancy, abandonment, which breeds, of course, and generates further abandonment and vacancy, so on and so forth. We also have this debt maturity wall. So office building owners are finding often, not everyone, not suburban office vacancy, suburban office space owners. I mean, many suburban markets still performing quite well. Often the issues are in historic central business districts, Class B, Class C space. And a lot of that debt has to be refinanced over the next 5 years. This is commercial real estate debt maturities. $2.5 trillion has to be refinanced over the next 5 years, including last year, as it turns out, that 5-year period. Who's going to refinance that debt? And in some cases, you're going to have building owners say, you know what, to the banker, I owe more to you than the building is worth. Here are the keys, you deal with it. Now, the banker's going to dodge those keys. It's going to lead to a negotiation, but that's where we are. We had a building in St. Louis, the AT&T building, 44 stories tallest building in St. Louis, apparently, that sold a few years ago for over $100 million, just sold for $3.5 million. Somebody's going to take that loss. And in that context, at least in certain downtowns, you're not seeing a ton of new construction. I mean, here are the highest downtown office vacancy rates as of the fourth quarter, according to CBRE. San Francisco, 36%, Wilmington, 34%. We're getting data now that the San Francisco vacancy rate is actually now closer to 38%. So that's an issue, obviously. And that takes me to the forecast. This is Clint Eastwood from the Dirty Harry films. There are 5 of them. The first one came out in 1971 called Dirty Harry. Now, in that movie, Dirty Harry, the character has a partner. The partner's name is Chico Gonzalez. And Chico Gonzalez is played by an actor who would later show up in the Seinfeld episodes playing the part of Poppy, the unhygienic restaurateur. Just a movie and TV history, completely irrelevant. Let's go to some leading economic indicators. Now, look. If I were an optimistic person, totally different presentation. If I had a girlfriend in high school, this presentation is much more optimistic. But because I didn't, this is what you're going to get for leading economic indicators. This is the Conference Board's Index of Leading Economic Indicators. It's actually 10 leading indicators, all bundled into one composite index being graphed for you here. It's an index that predicted the 2001 recession, predicted 07, 08, 09, and is now telling us something more wicked this way comes. And to get back to that question that was asked to me, I think what this is reflecting are those lag effects from these higher interest rates. And one of the things that the marketplace has learned this year is that these interest rates are going to be higher for longer because inflation is stubborn. And that's one of the things I actually predicted correctly. So are we going to get a rate cut this year? Yeah, maybe 1 or 2 at most, I suspect. And 0 is becoming increasingly probable. And in fact, increasingly the view among some economists is the next move by the Federal Reserve will be to raise rates. Now, it's still, in my mind, a small probability. But if inflation continues to come in hot like this, which it may not, but if it does, the Federal Reserve will have no choice but to start raising rates again to try to get to that 2% inflation rate. Yield curve is still inverted. So I won't go through all of this in the interest of time. We're already at 12:50 Eastern Standard Time. But when the green line is above the blue line, that means that the 1-year Treasury yield is above the 10-year Treasury yield. That's an example of an inverted yield curve. And the green line has been above the blue line, during previous recessions. So if you see the green line goes above the blue line before the 1970 recession, before 73, 74, 75, before 1980, before 81, 82, before 1990, 1991, before 2001, before 07, 08, 09. Not so much for 2020, that was caused something else, but we've had inversion of the yield curve since July of 2022, and it's been a really flawless predictive recession for decades. So go where we're looking and look where we're going. That's a line from a more recent Clint Eastwood film, 2021's Crying Macho. Was not a box office sensation by any stretch of the imagination, but was a critically acclaimed film. Again, it's a movie that Clint Eastwood acts in, but also directs and produces, and also dances, and not particularly well, but he dances. He was born in 1930, so as that movie opens up, he is 91 years old, still at it. We are deeply in debt society, currently facing high borrowing costs. That's what makes me pessimistic regarding the near-term outlook. And again, these higher interest rates are going to stay there for longer, more time to punish economic momentum. Geopolitics for elections don't help, source of additional concern, distraction, risk. We are actually waiting right now for an assault by the Iranians on the Israelis. So conflict is broadening. We saw obviously have conflict in Eastern Europe, China, Taiwan, so on and so forth. You wouldn't know from the stock market. I mean, Dow Jones has been above 39,000 until very recently, S&P above 5,200, NASDAQ above 16,000. But we've got some issues out there. And of course, we've got federal elections too, which also adds to the level of uncertainty. So it will come nearly a year after initially anticipated, but recession is coming in late 2024, very late 2024. I might be wrong about that. I probably am. So then I'll forecast recession for 2025 if I prove to be incorrect. And if I'm wrong about that, I'll predict one for 2026. I'll keep doing it until I'm right. And you might ask, why are you so stubborn, Anirban? Because at some point I will be right. And then I can retire and people will support that, boss. So you knew the economy, didn't you? You could forecast it. The other thing is that I see some imbalances in the economy that have yet to be worked out. And that's why I expect that at some point those imbalances will produce the next economic downturn. If you like this kind of data analysis, I have a newsletter at www.sagecon.com. There's a free service here. But for people who opt for the paid service, we're giving a 50% discount right now. If you're not interested in the newsletter, then please, 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 at any time, feel free to go ahead and pound sand. And with that, hey, let's go to Q&A. Thanks a lot for the opportunity.
Anirban, outstanding as always. Definitely appreciate the insight and remembering some of those amazing Clint Eastwood movies we might have forgotten about. If you could jump back to the CRE debt maturities slide you had, we had a lot of questions that really related to this. So one of the questions was, will sustained high interest rates affect tenant activity? Do you see this having an impact?
Yes, absolutely. And I'll tell you something that's happening, and I hear this from more building owners, and they're very frustrated by this. They're going to their banks and saying, I need money for tenant improvement, for TI. And the bank is saying, oh, you're not getting any money for tenant improvement because the money we would lend you, to pay us back would come out of cash flow. We want that cash flow to be spent on what you already owe us, not new debt. And so, this is going to affect tenancy. It affects the competitiveness of various buildings. It affects new construction because that vacancy is going to be stubbornly high. And one of the things that we've learned is that remote work is here to stay. People prefer it. And productivity numbers have suggested that productivity is just fine, maybe even expands with remote work. So again, I see a lot of liability here for banks and anybody else who uses office buildings as collateral or owns them. It could be equity loss, could be debt loss. But this is a major problem. And much of this commercial, by the way, not every commercial real estate segment is weak, by the way. But a lot of this CRE debt relates to the office market in particular.
Now, data has shown that lenders are allowing borrowers to extend maturity dates. Is there a trend in refinancing on these corporate debt to push that out and really create a bigger problem a couple of years down the road?
Oh, sure. There's a lot of kicking in the can down the road, because if I'm a bank and I'm being threatened with having to take the keys, I'm taking now ownership of this building, I don't want to deal with that because that costs me so much administratively and otherwise. I'm going to negotiate. So might I extend my debt terms for another year or so on and so forth with the hope that whoever owns that building can get more occupancy or can find another buyer for that building and just get me out of the whole deal? Of course. But it does not change the fundamental economics of the building, does it? It's a Class B, Class C building in a downtown that's struggling to attract tenancy. Rents are no longer climbing. There's lots of lease renewals coming up. And so you can kick the can down the road. You cannot escape this problem. Somebody's going to suffer this loss. It seems to be just macroeconomically, whether it's the bank or somebody else.
Yeah, and then combining two questions on the last two questions on this topic. Does the size of the potential defaults, is it large enough to have a material impact on the overall economy such that the credit issues could put downward pressure on rates? Or does the Fed kind of looking at purely at inflation and not what could happen if they keep rates too high too long?
Yeah, here's the thing. I mean, their mandate is not to keep the banking system healthy. Their mandate is to 2% inflation. Now, they have a regulatory function, of course, and they sort of botched that with Silicon Valley Bank's failure. People appreciate that. Was one of the reasons they're regulating more aggressively now is because they were embarrassed by Silicon Valley Bank and Signature Bank's failures in March of last year. So now they're regulating banks more aggressively, looking for unrealized losses, looking at balance sheets more aggressively, more intensely. And that has banks somewhat on the defensive. You've got certain banks like M&T Bank, which happens to be big in my region of Baltimore, but along the Northeast corridor, which has a ton of exposure to commercial real estate. Now, what I'm told by bankers there and some other banks that have that kind of exposure is, yeah, but that makes us more likely to want to make C&I loans, meaning commercial industrial loans, because we can't make any more real estate loans. We don't want to be further exposed to that. So we need to make loans in these other segments, commercial and industrial loans. And so, what that means is maybe the credit conditions don't tighten up across the board, only for certain segments of commercial real estate.
Yeah, different by asset class. Perfect. If you could back up one slide to every which way but down. I think you gave some color on this, but one of the comments was that the TI market was clearly impacted by COVID. Do you anticipate tenant improvements getting back to where they were, or are they permanently impacted by work from home?
See, I don't see. Again, one has to differentiate the markets, I think, because if you're in a suburban office market, if you're in St. Petersburg, Florida, you got no issues. You got plenty of tenants. You're in Miami, where all these financial services firms are moving, hedge funds and private equity and so on and so forth, from New York and Chicago. You've got no issues there. Again, it's some of these older central business districts, Class B and Class C properties, where banks are saying, I'm not going to lend you more for tenant improvements. Now the landlord cannot compete with other landlords for that tenant, so vacancy just keeps rising, and the value of that building keeps falling. Now, then the question becomes adaptive reuse. Can it be turned into a data center, apartment building, so on and so forth? Sometimes yes, often no. These are ceiling heights and ingress and egress and all these kinds of things. And so what can I tell you? I think we've got a real problem on our hands. And the question is this big enough to take down the overall US economy? I remember when people talk about subprime mortgages in 04 and 05, it's not big enough to take down the economy. You have a couple of banks. If you just have a couple of banks that really suffer because of this, that's enough. Lehman Brothers was the fourth largest bank on Wall Street. It falls to September 15th of 2008, takes the entire financial system down with it. It doesn't take much.
Yeah, for sure. No, I know you're a little shy, but and you tend to, you don't like to get into the touchy subjects. But let's dig into this one now that we're in an election year. Does your economic prediction for maybe 25 change much, whether it's a Trump victory or a Biden victory? And then, do you have any grave concerns with either, from an economic perspective, with either candidate winning?
I have grave concerns with either of the candidates winning. As it turns out, what threatens the nation more than anything else? I mean, we could talk about short-term things like the office market and credit card debt, but what really threatens the union economically is our national debt. Something I didn't talk about, and it's not a near-term issue because people are still buying treasury bonds, treasury auctions are still orderly, so on and so forth. But a $32.4 trillion national debt, impending insolvency of the Medicare and Social Security trust funds in the early 2030s, we've got a problem here. So in the 2020s, the federal government is spending aggressively, whomever is president, and subsidies for manufacturers and lots of infrastructure spending and so on and so forth. It really juiced the economy. 2030 is going to be very different because the money will have run out by then. And so I'm very concerned about that. So what I would like to hear either one of the candidates say, or certainly both of them, I'm going to deal with this federal budget deficit. I'm going to bring it down. I'm going to get serious about it. I'm not going to just talk about revenue neutrality and these kinds of things when I cut taxes. I want to actually mean it, because that's what we need to have a sustainably strong economy. But again, I didn't focus on it because it's not a 2024, 2025 issue. That's a longer-term issue, and we Americans are in some trouble here. And by the way, a lot of people talk about American exceptionalism, and we are exceptional. There's no question. We own the commanding heights of many leading industries. We're number one in AI. Don't take that for granted. But we often do as Americans. We're going to be the leaders in every emerging technology field, biotechnology, whatever it happens to be, and we often are. But it's really coming something quite remarkable about us. It is exceptional. But one of the other ways in which we're exceptional is that the federal government spends the way it does. It borrows the way it does. And in Europe and in Canada and elsewhere, you don't see that kind of reckless spending. And I think ultimately that's going to get us into some trouble.
Yeah, speaking of kind of AI and technology, really just to bring one more question back to the industry. Construction technology investments, they heated up a lot in 2021 and 2022. There was a ton of M&A activity. I think 22 was kind of the peak at almost $5.5 billion worth of deals. That those M&As dropped by about 44% last year, came in right around $3 billion. Do you have any input into the outlook for construction technology, or how maybe why those deals pulled back, and if we expect an expansion and increase that will help fuel efficiencies to drive our industry?
It's just cost of capital, I think. Those deals are very expensive to finance. Somebody's acquiring somebody else, often with debt, sometimes with equity, but often with debt. If debt is more expensive, the deal doesn't make as much sense. So the pace of consolidation in the industry slows. and that's across industries, not just construction technology. I would say to you this: size matters. That to really advance technology, to engage in R&D, and to infuse advancements through the workforce, one's workforce, to provide that kind of training and shifts and protocols and standard operating procedures requires some scale. And so there are scale advantages in construction technology and the diffusion thereof. And as a result, I would expect to see a lot of industry consolidation during the years ahead. The big will get much, much bigger as interest rates come down and these deals make much more sense financially. So it's just a matter of time. And so what you have is, with the relative absence or dearth of deals in the short term, you have an even buildup for an appetite for deals in the longer term once these costs of capital come down. So I think you will see frenetic deal making in years like 2025, 2026, 2027, when interest rates are much lower than they are now.
Excellent. Well, thank you, Dr. Basu. Always educational, always entertaining. Greatly appreciate your insights. Big thank you to all of our guests online. It's great to bring the Masters Series back on today, the 11th of April, when the Masters itself is starting. Look forward to connecting with everybody in the industry out in the field and out at events. So thank you all once again. Appreciate it.